Welcome to the Deep Dive. I'm your host, and today, I'm really excited because we're diving into an article I wrote for my blog, bullishbooks.com. And here's something I bet you've noticed. Maybe it even bugs you a little. You finish school, right? You know how to maybe bake bread, or you remember some historical dates, perhaps balance a checkbook. But where's the class on how to actually build wealth systematically through investing?
It's a huge gap, isn't it?
It really is. It feels like this massive missing class. And I argue in my piece, this missing knowledge, it could be costing you a fortune every single year.
That's a powerful point. It's not just academic. The financial consequences are very real. Delaying means missing out on that crucial compound growth.
Exactly. So this deep dive, it's all about uncovering those essential investing principles that, frankly, most of us just never got taught. My article, it's called Learn to Earn, Peter Lynch's Simple Guide to Wealth. And yeah, it draws heavily from the wisdom of the legendary investor Peter Lynch in his book, Learn to Earn. My mission for you today really is to give you a shortcut, the solid foundation you need to actually start your investing journey.
Or maybe just deepen the knowledge you already have.
Right. Whether you're just curious or you're ready to get serious about financial literacy, we want to pull out the practical stuff, the actionable insights you can use, like today. Okay, let's jump in. My article kicks off with what I called a bit of a truth bomb. How is it we spend years in school learning all sorts of things?
History, science, home
Release, all that,
Yeah.
but almost nothing about building financial security through investing. It's pretty wild when you stop and think about it.
Well, what's fascinating, and Lynch really hammers this home in the material you cover, is that this isn't just some, oversight. It costs people real money. Every year you wait, that's a year of compounding you've lost forever. It really makes you ask, why isn't this basic knowledge just standard curriculum?
Right. And Lynch's point, which I highlighted, is that this isn't rocket science. He says it's for regular folks using maybe fifth grade arithmetic.
But
Just patience. It's accessible.
patience being the key word there, often the hardest part.
Definitely. It's not about being some Wall Street genius. It's about understanding and, crucially, applying simple, proven ideas. And before we even talk stocks or bonds, my article makes a really fundamental point. Investing, at its core, is about business ownership. What does that actually mean in practice?
Yeah, the article breaks it down nicely into two main paths. First, there's private ownership.
Like owning a local shop.
Exactly. Your neighborhood restaurant, a friend startup. You have direct control. You get all the rewards if it succeeds. But, and this is key, it usually takes a lot of capital. Plus, your risk is super concentrated. Everything's riding on that one business. And getting your money out selling can be tricky.
Okay, so high potential, but also high risk, high commitment.
Precisely. Then the second way, and this is what investing usually means for most people, is public ownership, buying stocks.
So owning tiny pieces of big companies.
Tiny pieces, yeah. Think Apple, Coca-Cola, companies traded publicly. The amazing thing here is the accessibility. You can start with like $50. You can easily spread your risk across many different companies, diversification, and you can usually sell your shares whenever the market's open. That's liquidity.
But you don't get to tell Tim Cook what to do.
No, definitely not. No direct control. And you have to accept that prices will bounce around in the short term. That's the trade-off.
And I really tried to drive home this idea in my writing that public ownership kind of democratizes owning a business. It makes it possible for almost anyone. I even suggest that just paying attention to what you buy, what stores are busy, that's actually a form of research.
That's a great perspective. Using your everyday experience.
Okay, this next part in the article, I think it really makes you pause and think. It poses a really fundamental question. Should you go all in, start your own business, or invest in other people's businesses through the stock market?
They can both lead to wealth, absolutely. But wow, are they different paths?
Totally different. So how does the article frame the entrepreneurial route?
Well, it presents entrepreneurship as the, high risk, high reward option, the upside. Potentially unlimited. Think early Microsoft, early Walmart. You have complete control, huge personal satisfaction if it works, maybe some tax perks, building a legacy.
Sounds amazing if it works.
If it works. That's the big if. The article is clear about the reality check. The failure rate for startups is incredibly high, like 90% fail high. Yeah. And it demands insane hours. 80-plus hour weeks aren't uncommon. You need significant capital up front, usually. All your risk is in one basket. And the stress, the uncertainty, it's immense. It takes a specific kind of person.
Okay, so that's the intense roller coaster of entrepreneurship. What about the other side of the coin? Investing in the stock market.
Stock market investing, as the article lays out, is more of a steady, wealth-building path.
The advantages are pretty compelling, too. You get instant diversification, you benefit from professional management, thousands of CEOs and teams running the companies you own pieces of.
Right, you don't have to run them yourself.
Exactly. The barrier to entry is super low, you can start small, it's liquid, you can generally sell easily. And historically, over the long haul, like a century plus, stocks have been the most reliable way to build wealth. Plus, you can get passive income from dividends, and it offers time freedom. It doesn't demand those 80-hour wets.
Okay, sounds pretty good. Steady, diversified, accessible, but there are always downsides, right? What are the trade-offs with stocks? Oh, absolutely. Key trade-offs. You have zero control over how the companies are run. Market volatility is real prices go up and down, sometimes sharply, and that can mess with your emotions.
Yeah, it's easy to panic sell.
Very easy. And your returns are likely to be, well, average market returns. You probably won't get that 1000x return like an early-stage founder might dream of.
Yeah.
And managing those emotional swings is a big challenge for many investors.
So for you listening, trying to figure this out, my article offers some pointers. Entrepreneurship might be for you if you've got that killer idea, the expertise, you can afford to lose the initial cash, and you, thrive on pressure. But stock market investing, probably a better fit if you want steady growth, value your time, don't have huge startup funds, or just prefer spreading out your risk.
And it's not always strictly one or the other, right?
Yeah.
The article touches on a hybrid approach, too.
Yes. That's a great point. Many successful people combine them. Maybe start investing early, build skills in your job, save like crazy.
Build that foundation.
Yeah. Exactly. Build that launch pad. Then maybe take a calculated entrepreneurial risk later when you have a safety net.
Makes sense. Start with the steadier path, then consider the higher risk one.
Right. But the bottom line of my piece is pretty clear. For most people, regular folks in America, patient stock market investing is the most reliable route to financial independence. A few entrepreneurs strike gold, sure, but millions build real wealth just by consistently investing over time. Now, before diving into how to invest, my article takes a quick detour into history, which I found fascinating when researching this. It looks at how capitalism basically shaped the modern world and why that history actually matters for your portfolio today.
That's a really important context. The article traces it back to the Virginia Company of London, way back in 1606, one of the first examples of people pooling money by buying shares in an enterprise.
Wow, 1606.
Yeah. And these core ideas, they still drive markets today. The piece mentions Adam Smith's invisible hand. Sounds mystical, but the article explains it simply. It's just the idea that millions of individual choices, what to buy, what to sell collectively, guide resources efficiently, without some central planner telling everyone what to do.
Which is the big difference compared to, say, the Soviet Union's planned economy, which the article contrasts it with.
Exactly. That planned system just couldn't match the flexibility and efficiency of markets, driven by individual choices and the pursuit of profit.
And this isn't just a history lesson. I argue it's vital for investors because it shows why owning stocks works long-term. Companies that successfully figure out what people need or want, they grow, they make profits.
And their stock prices tend to follow, rewarding the people who own those shares.
Think about the big shifts. Railroads, cars, computers, each created massive wealth for investors who saw the potential.
That pattern repeats throughout history. Economic progress fuels investment returns.
Okay, so knowing that history, where can you actually put your money? My article lays out 5 basic investment categories. Let's quickly run through them so you understand the landscape.
Sure. Starting with the most familiar, maybe.
Yeah.
Number 1, savings accounts. Super safe, your money's insured, but the interest is usually tiny.
Barely keeps up with inflation, right?
Often, yeah. So your actual purchasing power might even shrink. Good for your emergency fund, the article says, but not for building long-term wealth.
Got it. What's next?
Number 2, bonds. Basically, you're lending money in IOU to a government or a company. They promise to pay you back with interest.
Seems safer than stocks.
Often perceived that way. But the article points out key risks. Interest rate risk. If rates rise, your older, lower rate bond is less attractive. Inflation risk. Rising prices eat away at the value of your fixed payments. And default risk. The borrower might just not pay you back.
Okay, so not risk-free. What about houses?
Number 3, real estate. The American dream for many. It has tax benefits, the mortgage acts like forced savings, and it can hedge against inflation. But big BET here.
Needs a lot of cash up front.
Usually, yeah. Significant capital.
Yep.
And it's not like stocks where you can sell a few shares tomorrow. Selling a house takes time. It's illiquid.
Okay. Number 4.
Number 4, precious metals.
Ew.
Gold, silver. My article, drawing from Lynch, calls them a shiny distraction
Haha, why is that?
because they don't do anything. A gold bar just sits there, doesn't employ people, doesn't innovate, doesn't generate profits.
Unlike a company.
Exactly. Companies use capital to create actual value. That's the fundamental difference for long-term growth.
Which brings us to the last one.
Number 5, stocks. The article calls this the wealth-building champion. Yes, they're volatile short-term, but history shows they offer the best potential for long-term growth because you own pieces of active, productive businesses aiming to increase profits.
And that's the core idea I keep coming back to in the piece. You're not buying lottery tickets, you're buying ownership in real businesses that are working hard every day. That mindset shift is crucial.
All right, let's shift gears slightly. There's one asset you have as an investor that's maybe more powerful than anything else, but often overlooked. Time. My article includes an example on this that honestly blew my mind when I first read Lynch's take on it.
It's a classic illustration, and it really drives the point home. Okay, picture this, straight from the source material. Investor A puts $2,000 a year into the market from age 14 through 21. That's only 8 years, $16,000 total invested, then stops completely.
Just lets it ride.
Lets it ride. Investor B starts later, at age 22, invests the same $2,000 a year, but does it religiously all the way to age 65. That's 44 years of investing, $88,000 total.
Okay. Who ends up with more?
Assuming the same average market return, Investor A, the one who started early and stopped, often ends up with significantly more money at retirement.
Wow. Just from those first 8 years. It's the power of compound growth. Those earliest dollars have decades upon decades to grow and earn returns on their returns. It's exponential. Time is your superpower in investing. Starting early is huge.
It's just, yeah, incredible. Makes you want a time machine. But okay, knowing time is key, what about the pitfalls? My article also flags some common mistakes that trip up investors. We need to help people avoid these.
Absolutely. The article lists 4 big ones. First, trying to time the market. It's almost impossible to do consistently. People tend to buy high when things feel good and sell low when things look scary. The exact opposite of what you should do.
Buy high, sell low. The classic mistake.
Right. Second, panic selling during corrections. Markets normally dip 10%, 20%, sometimes more. It's part of the cycle. But fear takes over. People sell at the bottom, locking in losses instead of seeing it as a potential opportunity.
Been there, done that.
Early on.
What else?
Third, chasing last year's winners. Just because a stock or fund did great last year doesn't guarantee future success. You need to look at the underlying business, the fundamentals, not just past performance.
Don't drive looking only in the rearview mirror.
Good analogy.
Yeah.
And finally, number 4, over-diversification. Spreading your money too thin across hundreds of stocks can actually dilute your returns. Lynch argues you only need a few good companies you understand well.
Okay, those are definitely traps to watch out for. Now, if digging into individual companies sounds like, well, a lot of work.
Which it can be.
My article highlights a really good starting point, especially for busy people. Mutual funds. What makes them so useful?
Mutual funds are great because they pool money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. You get instant diversification and professional management all in one package.
What kinds are there?
The article mentions the main types: stock funds for growth, bond funds for income, money market funds for safety, like a savings account almost, and a really important category, index funds.
Ah, yes, index funds, low cost.
Very low cost, typically. They just aim to match a market index like the S&P 500 by holding all the stocks in it. It's a simple, effective way to get broad market exposure and average returns.
And when picking any mutual fund, not just index funds, what should people look for, according to the article?
Key criteria mentioned are low fees, high fees eat into your returns, so look for expense ratios, preferably under 2%, ideally much lower for index funds. Long-term performance, check the 5 or 10-year track record, not just last year. Understand the strategy, know what the fund is actually investing in, and maybe check the manager's tenure consistency can be good.
And I also make sure to emphasize the power of automatic investing in my article, that idea of dollar cost averaging.
Oh, that's huge.
Just setting up a regular automatic investment, say $100 every month, no matter what the market is doing, it takes the emotion out of it.
Right. You automatically buy more shares when prices are low and fewer when they're high. It's a disciplined, unemotional way to build wealth steadily over time. Simple, but really effective.
Okay, so funds are a great option, but for those who do want to try picking individual stocks, my article ranks the common methods from pretty bad to the gold standard. Let's walk through those.
Yeah, it's a useful hierarchy. At the bottom, method #1, darts. Literally like throwing darts at a stock page. The article really says if you're doing that, just buy an index fund instead. It's pointless gambling.
Agreed. Next.
Method #2. Hot tips. Your brother-in-law tells you about a sure thing. This is dangerous, usually based on hype or rumors. Lynch's quote you included, it's perfect. People never lose money on stocks they don't own. Just stay away.
Good advice. Method 3.
Method #3. Educated tips. This is maybe a bit better. Tips from people who might actually know something, professionals, maybe industry insiders. The article says these can be useful leads for your own research, but never follow them blindly.
Still need to do your homework.
Always. Then method #4. Broker buy lists. These come from professional analysts. A reasonable starting point, the article suggests, based on actual research. But remember, brokers might have incentives to encourage trading activity.
Okay, so use with caution. Which leaves the best method?
Method #5. Your own research. This is what Lynch champions and what my article emphasizes as the gold standard. Choosing stocks because you've actually looked into the company, you understand the business, you like its prospects.
And this connects back to that earlier idea of using your own experience, right?
Exactly. Noticing busy stores, liking certain products, understanding industries you work in, that's valuable insight. Then you combine that with reading annual reports, checking the financials, doing the actual work.
It really comes back to that crucial mindset shift I stressed in the article. When you buy a stock, you're not just trading a ticker symbol, you are becoming a part owner of a real business. Thinking like an owner changes everything.
It really does. As an owner, the article explains you get a share of the profits, dividends, you get voting rights, you benefit if the company grows, but you also accept the risks.
And what does it mean for the companies and the economy?
Well, for the companies, your investment provides capital, money they can use to expand, innovate, hire people. For the wider economy, it means capital flows towards promising ventures, funding innovation, creating jobs, ultimately raising living standards. It's a positive cycle.
A lot of people think significant wealth is mostly inherited, but my article points out analysis like from the Forbes 400 list showing that's often not true. The majority are self-made.
That's a really important counter-narrative. The article even mentions those famous dropout millionaires, Bill Gates, Paul Allen, Ted Turner.
Yeah, it's not saying drop out of school.
No, definitely not. The point, as the article suggests, is that huge success often comes from seeing an opportunity, working incredibly hard, taking smart risks not just from your background or even formal education.
It's about solving problems people have, like Walmart did with low prices, or starting small and reinvesting relentlessly like Ray Kroc with McDonald's, thinking long-term.
And again, the impact goes beyond personal wealth. Think of the millions employed by Walmart, the technological revolution spurred by Microsoft. These leaders drive massive economic activity.
Okay, so if you're ready to do your own research, thankfully today we have more tools than ever. My article lists some key resources.
Yeah, the information access is incredible now. Annual reports are fundamental. Companies have to publish them, full of financial details. Then you have great publications like the Wall Street Journal, Barron's, Value Line for news and analysis.
And understanding the basics of financials is key. The article mentions the balance sheet.
Right, the snapshot. Assets, what it owns. Liabilities, what it owes. Shareholders' equity, the owner's stake. And looking at trends in revenue growth, profit margins, debt levels, cash flow that tells you the story of the business's health over time.
I included that fictional example, Compass Peak Corporation, to illustrate this. How a company might start out burning cash, needing investment, but eventually turns profitable, generating cash. You can see that journey in the numbers if you know where to look.
That kind of case study really helps demystify the financials. But it's not just about individual companies, right? Bigger economic forces are always at play.
Definitely. What are some of those big picture things investors should be aware of, according to the piece?
Well, government policy is huge. Interest rate changes from the Fed, new regulations, tax laws, trade agreements, they all ripple through the economy and affect different industries. And then there are economic cycles. Recessions obviously impact most companies, but the article notes they can be great buying opportunities if you're brave. Expansions generally lift stocks. Inflation can hurt bonds, but might help companies that can easily raise their prices. Deflation is generally bad for profits. Understanding this context helps.
So, pulling all this together, what's the blueprint? What's the core advice my article distills for someone who wants to succeed at investing?
It boils down to remarkably simple yet powerful principles, echoing Lynch's wisdom. Start early and invest regularly. Time and consistency are your allies. Focus on businesses you actually understand. Don't invest in biotech if you don't get biotech. Buy what you know. Leverage your own consumer or professional experience.
Makes sense.
Hold for the long term. Wealth isn't built overnight. Think years and decades. And maybe most importantly, don't panic during downturns. See them as potential opportunities, not reasons to sell everything.
So let me just recap the absolute core takeaways from my article's summary. 1. Investing is owning businesses, not playing the lottery. 2. Time is your most valuable asset. Start now. 3. Educating yourself pays dividends, literally. 4. Mutual funds, especially index funds, are a great tool for diversification and professional management. 5. Think like a business owner. 6. History shows patience wins. And 7. Your everyday life gives you valuable investment insights. The article references how these principles, applied consistently, turn millions into billions for legendary investors. The same basic ideas can work for you too, even starting small. And that really leads to the final thought I wanted to leave you with today. The real question isn't, can I afford to invest? It's, can I afford not to? Every single day you wait is potential growth you can never get back. So what's holding you back from taking that first step or the next step toward your own financial independence?
The information is out there. The tools are accessible. As this deep dive based on your article shows, the path is understandable. It's about taking that knowledge and putting it into action.
Absolutely. I really encourage you to visit my site, foolishbooks.com, for the full article we discussed today, plus lots more resources and insights on investing and personal finance. And please subscribe to the newsletter while you're there. We send out deep dives like this regularly. Thanks for joining us on the deep dive. Remember, that journey towards financial freedom, it really does start with taking that first step,